Welcome to the Video CPA. It's good to be with you again today. We are talking about rental property today. We're going to do that in two parts, and I'd have to say that this is easier of the two parts. Rental property is pretty straightforward when you're dealing with just your rental income and your expenses. But next week we'll be talking about actually acquiring rental income, setting up your basis, depreciating rental income, and then calculating your gain when you sell. Gain or loss when you sell rental income. You've already seen the two disclaimers that we have, one for affiliate marketing and one for our education disclaimer. So we're ready to go ahead and start this video. Let's talk about rental income for a few minutes. Rental income, whether it comes from a rental property such as real estate or equipment or whatever, is going to have to be reported on Schedule E for individuals. Now, if you're a business, you could use 8825, but we're talking about individuals today, so we're going to talk about rental income being reported on Schedule E. Now, it's important that you report each one of your rental properties separately. Don't combine your rental properties because it becomes much more difficult when those are sold to separate out the basis and calculate the gain and loss. So have a separate Schedule E for each one of your rental properties. Now you will notice that you can put 3 properties on each Schedule E, so but separate those properties. Let me address at this point the difference between a cash basis taxpayer and an accrual basis taxpayer. A cash basis taxpayer is going to include rental income for taxes in the year that they receive the money, and they will deduct expenses against that income in the year that they spend the money. Now, that is not quite the case with an accrual basis taxpayer, because an accrual basis taxpayer is going to include an income in the year that they actually have earned the money, and they will deduct expenses in the year that they actually have a liability to pay the money. With that introduction to cash and accrual basis, just let me say that I have never seen an individual on an accrual basis in my 45 years of doing tax returns. Everyone has been on a cash basis. So with that, let's talk about advance payments. If you receive, for example, the payment of a first and last month's rent, and you're a cash basis taxpayer, you have to include both the first and last month's rent in your income because you've received it during that year. If you're on an accrual basis, well then certainly the first month's rent would be taxable. The last month's rent could be put on a balance sheet and suspended until you actually have earned that last month's rent. So just be aware of how that works, and we'll talk about that a little bit more with rental deposits. Let's talk about cleaning and maintenance deposits for a few minutes. If you receive cleaning deposits, for example, they're going to be handled a little bit differently than what your advanced rentals are. So if you receive a cleaning deposit, you can include that cleaning deposit in income, and then when the tenant moves out, you can actually deduct it later if it's refunded. Now the option is, and the IRS does give you an option to hold that cleaning deposit in suspense until the tenant leaves, and then at that time, if you keep that cleaning deposit, then you declare it in income at that time. I would do the first, because most people will forget. Unless you have a complete balance sheet on that property, you're going to forget that you did not declare that cleaning deposit as income in the first place, or that you held it in suspense, and you're not, if you keep it, you're going to forget that it should be income. So make sure you, in most cases, I would do the first. In fact, I would do it in all cases unless I'm keeping a complete balance sheet on the property. Let's turn to rental expenses for a few minutes. Rental expenses are those expenses that are ordinary and necessary to manage, conserve, or maintain your rental property. And if that's the case, they're deductible. So on this particular slide, you can see that we have some examples, and not necessarily limited to this list, but these are some of the expenses that you can deduct as a deductible rental expense under Schedule E. So just take a look at those: mortgage interest, property taxes, insurance, cleaning, maintenance, any supplies that you need, repairs, advertising, utilities, travel expense. That would include mileage on cars, that type of thing. So look at those carefully. If they're incurred in the operation of that rental property, then they're going to be deductible. The IRS makes a distinction between expenses that are meant to maintain or conserve the property versus expenses that are meant to improve the property. And so you need to understand what that distinction is, because expenditures that are to improve the property have to be capitalized and cannot be expensed in the period. So they have to be written off through depreciation over a number of years. And depreciation will be the next topic in my next video. We're going to talk about depreciation and how to set up basis and that type of thing. So I'm not going to go into it a great deal today. But the costs of improvements are going to have to be depreciated over time. And in the next video, we'll talk about what some of those improvements might be. To calculate your rental income or loss, you're going to subtract your expenses from your rental income, and that will give you whatever your loss might be. That's going to be reported on the bottom of Schedule E, and it will transfer over to line 5 of Schedule 1, which is the other income schedule. From there, it goes to the other income line on the front of the 1040, which is line 7, and that'll be on the 1040 or the 1040 SR. Now, you need to understand that losses are going to be subject to passive activity rules, and they may not be fully deductible. So it depends on the amount of losses that you might have from your rental activities. Under the passive activity rules, taxpayers are allowed to deduct up to $25,000 per year if they're active participants in the rental property or properties. That is, if your modified adjusted gross income is under $100,000. Between $100,000 and $150,000, that deduction will phase out until at $150,000 there's no deduction whatsoever. If you have losses over $25,000, those losses are suspended actually and carried over until there's passive activity to apply those losses to. If you desire to have or to write off more than $25,000 a year, you're going to have to qualify as a real estate professional. That is beyond the scope of this video, but if you'd like me to prepare a video on that, I will do so. Just put it in the comments section, and if I have enough comments, I will prepare a video on how to qualify as a real estate professional. In conclusion, rental property can be a very good long-term investment. Not generally a good short-term investment, but long-term. Remember that your losses might be limited, and make sure you tune into my next video, which I should get out in a week or so, which will be discussing the purchasing, depreciation, and selling of rental property, which I think is a more complex part of owning a rental. So with that, I appreciate your viewing. Please like and subscribe if you're so inclined, and visit a sister channel of this channel, and that's Seniors in Action. And we'd like to have you there. So good living until next time.